Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamanik back to the stage, who's coming back from vacation. How are you doing, Dima?
Good morning, Will. How are you?
Good.
Thanks. And let me share my screen here, or let me know.
There you go. All right, we're ready to go.
Good morning, everyone. And today what we'll do is take a look at different ways to chart a stock volatility, and we're going to get different perspectives on where the volatility is coming from. So let's use we'll use SPY in our example. I'll type in SPY in the search box. This will take us to SPY's main summary page, and on the left-hand side, let's click on volatility, and then we'll do stock volatility. So click on that. This brings up a new page. I'm going to click on this menu to minimize and expand our screen. And up here, we have these 4 different selections. Let me just start out with this open, high, low, close. And this line here, it's selected to the open, high, low, close. And what it does is looks at the last 20 days. And it uses the SPY's opening price, high price of the day, low price of the day, and closing price of the day. And then it looks for the last 20 days and calculates the volatility based on those reference points. And the idea there is it tries to capture the essence of the volatility using the lowest price and the highest price it traded on the day, the opening price and the closing price, and the gap between the closing and the opening. So it really tries to use all those prices to try to measure the volatility of SPY. So you can see here, this is a line chart that is day-to-day going back a year, looking at the 20-day historical volatility of the stock. So another way to measure, there's no single right way. It depends on just what you want to reference, the prices you want to reference. But we could also use just close to close prices. So to look at the last 20 days and see where did the stock close from this day, where did it close the next day, then the next day, and so forth. So we could calculate the volatility doing that, and then we could plot it against this open, high, low, close, and it'll give us an idea where volatility is coming from, or where it's greater. So like, for example, let's say the stock closed at one price, opened at a higher or lower price, moved around from a high, low, a really big range. And then at the end of the day, it closed at the same price as the previous day. Well, then it would have a lot of volatility, but if we just use close to close, and the close to close prices are the same, it'll show no volatility. So you'd have like this straight line, no volatility. So if that's happening, we would say this straight line is 0, but the open, high, low, close would be much higher above it. So let's plot them next to each other. And now you could see here that they're following each other. So the volatility of both over time either decline or go up. And here we see a little bit of a larger gap between the open, high, low, close and the close to close, suggesting that there's more intraday volatility than just the close to close prices. And that's why we're seeing this gap here over here between close to close and open high low close. And it's kind of like now they're coming together more closely. Okay, so if there's a big gap, it's suggesting that we're seeing a lot of intraday volatility, even though the stock itself from previous day to the next day isn't experiencing as much. It's not closing at the high or the low of the day. It's moving around, closing closer to the previous day's close. Okay, so that's one way just to visualize how the volatility is moving over time when we reference those different prices. Another line we could plot is just the open to close. So the open to close tracks where did the stock open on the day, and then where did it close. So this would take out the overnight gap, right? Because the close to close would also include any kind of gap, open, high, low, close. But what if we just wanted to track just the intraday volatility? And the idea there is, well, if there was a big gap in the morning and then the stock from the morning to the close stayed the same price, well, the open to close would have zero volatility, right? So if every day we experience big gaps and then very little volatility till the end of the day, we'll see like this straight line well below these. Okay, but if there's a lot of movement from the opening to the close, then we'll see a higher volatility. So let's plot that. So here we get this yellow line, and you see that there was this initial gap here where it suggested that a lot of the volatility was due either to the gap or to the high low of the day. But the intraday volatility was lower, and then it started to pick up. So right now the intraday volatility, or at least the drift from the open to the close, is starting to also come up with the rest of the lines. Okay, so now that's also contributing to a higher volatility. Okay, so we got the open, high, low, close moving up, the close to close, and the close open, just open to close. So these are different reference prices. Next one that we'll do, the last one, is the previous day's close to the next day's open. And that shows you the gap. So the gap would be the stock, the market officially closed. Let's say the stock closed at 100, but the next day it officially opens at 110. Well, that's a 10% gap, right? Because there was an official close and there was an official open, and the prices changed dramatically. So the idea there is if we see a lot of volatility, but the close to open, if it closes at one price and opens at the same price the next day, there's no volatility, and then the volatility takes off. This line would be well below. But if a lot of the volatility is coming from those gaps, right? So if we're seeing the stock close, but then there's sensitivity to the market based on overnight news or events or things happening around the world, that we're seeing major repricing right at the open, we would see this close to open line moving up. So let's look at that. So here we see also over here, maybe right here around this area, there's a big discrepancy between the volatility going up, but from day to day, we didn't see a lot of gap activity, or the market would open similar to where it closed the day before. But now that line is moving up as well. So now what this was indicating, that all these different metrics that we look at from different perspectives, is it coming from overnight gaps? Is it coming from intraday drifts from the open to the close? Is it coming from the day's volatility to the high and the low range of the day, or just the close to close, all of these are now starting to move up. So we're seeing volatility increasing in all those different perspectives or aspects of the trading reference prices. So Will, I'm going to stop right there and throw it back to you. But I think that covers all those 4 points.
Hey, great job, D, and welcome back, my friend. Hopefully you had a great vacation. Great first show of the week. Thank you.
All right. Thanks, everyone, for joining. Stay safe. Have a great trading day. We hope to see you tomorrow.
All right. Have a great day, D. We'll see you tomorrow. Bye, my friend. All right, everyone. Thanks for joining another Market Chameleon webinar, breaking down stock volatility. Dimitri did a great job. First day back from vacation. Everyone have a great, safe trading day. Remember to like us and follow us on all the social platforms. Thumbs up, always appreciated. Everyone have a great trading day, and we will see you tomorrow. Have a great day. Bye.